Next up, we're going to discuss the concept of liquidity. Now, what is liquidity? When you speak about liquidity, that's basically the orders in the market. If anyone needs to buy euro dollars, they're going to have to find the orders in the market. Or if they want to short it, they're going to have to find those orders also in the market. And institutions have big orders to fill, and they need to create the liquidity. The more liquidity they can create for a move, obviously, the better for them. All right, so the market is drawn to liquidity. That is, at least on the short run, that is the biggest driver of the market. It's always going to move to where it's going to make the most money. Like I said, it's going to have to stop out traders, fill up orders, offload orders. These pockets of liquidity attract the market like a magnet. When traders stop out, the market maker gets to fill their orders, take the other side of their orders, and that's how they find the liquidity to do what they do and to make their money. This liquidity also acts as fuel to keep the market going. So like I said, it's always going to have to look for this or create this for it to move to where it wants to go. Now, without the fuel or the liquidity, the market's not going to move. Until it finds that, it's going to be stuck, or it's going to be in a range, or it's going to create the liquidity for the move. All right, so I'm going to show you guys a practical example here of a pound USD daily chart. This market printed this big high here and then had several days where it came down. So any trader that shorted the market over here has got a short order in the market, and these traders have their stop losses above here. Like every single textbook tells you, place your stop order or your stop loss above the high of the market. So if you are short the market, if you want to close your order, in a sense what you're going to do is you're going to have to buy back your order. So when you've got a stop order here, you've got a buy stop over here. So if all the stop orders are up here, buy stops, then this is where the liquidity will rest. The market, once it gets there, will pick up a lot more orders than anywhere in the middle here. So the market, if the market wants to go down, if it can stop out these traders before then, it'll do so. And just moving a slide forward, as you guys can see, the market actually moved up, cleared these highs, and again, now all those stop orders that the traders placed here were triggered. So they were all buying back their orders, and which means they were selling it to the market maker. So now with the market maker picking up a bunch of sell orders, it can move to the other side. And now just looking at this chart, looking at where you can find other pockets of liquidity, obviously every low will be a pocket of liquidity. But what we have down here is clean lows, and clean lows like double tops and double bottoms are perfect places for liquidity. Again, every textbook tells you a double top or double bottom, you can take the trade with your stops just above it. So there's definitely a lot of liquidity over there. And moving one slide forward, after the market took the highs over here, it came down, and it actually ended up taking the liquidity down here. Just another example. This is a Euro USD 1 hour chart, and the market was in a bit of a range over here, and then the FOMC brought out a statement. Again, this was a media statement, and it drove the price lower. If you don't know what you're looking for, you'll ask yourself, okay, well, maybe it was a bad statement for the euro, or a good statement for the dollar. So the euro dollar will fall. But if you look on the chart, where did they actually drive this market? And you can draw the liquidity in there. It actually even spiked these lows here, but the market just pushed down, took all the traders down here, and then it had the liquidity, and this was after many hours of an up move. It actually just came down, killed all those people down there. And once it takes this liquidity, where's it going to go? Most likely to the other side of liquidity. So yeah, the market jumps up, and this was the next day. Just before, the ECB president, Mario Draghi, was set to release a statement, this was where the market was sitting. So moving a little bit forward, this was the liquidity on the other side. And as soon as Mario Draghi brought out the statement, as you guys can see, a price spiked up, took those highs, and then came crashing down. So this was two media events, shook out the traders at the bottom, shook out the traders at the top, and then it made its big move. So yeah, this is actually quite tricky if you're a trader and if you don't know what to look for, and if you don't know the market's playing these tricks. But we're going to teach you, and we're going to cover stop runs and liquidity a bit more in future chapters. But for now, I just want you guys to know that the market is drawn to these liquidity points, and it is designed to stop traders out and not to make traders any money. Another famous example here was on the Euro USD. And this was actually the one I covered a little bit earlier, once they started calling for parity. This was the 2-year accumulation, where they accumulated the orders, and now they're ready to move the price up. But before they can do that, they got to stop all the traders out, and the media starts releasing the parity calls, breaks out, all the breakout traders go short here, and the market actually ends up reversing. There's a famous chart by Wyckoff called Accumulation and Breakout, and the previous chart actually resembles this quite significantly. It's one I want you guys to study, and basically we're going to go through what happens in this chart. And like I say, the market was doing this accumulation, and Wyckoff describes this move down as the spring, and this is basically where it shakes out enough traders, picks up the last liquidity, and then jumps up. We call this an impulse move, and then the market makes a correction, moves up again, market accumulates again, moves up, corrects, moves up. And this is like I say, you guys can reference this chart every now and then. It's a great example of how the price moves. And yeah, we're going to look at some examples in some future modules. And yeah, this liquidity concept, not only on the weekly and the big charts, it's also on the smaller time frames. Just looking at the Euro-Dollar 5-minute chart, again, the market had this big run down for hours and hours, took the highs, came crashing down, and then again had this big range. And there was supposed to be a big move up. This was a news release, but before then, it created all these orders down here, and then spiked down, took the liquidity, that fueled the move to the upside. So yes, this really is a great concept. When I was working for the training institutions, no one taught us this concept. It's not, most training institutions don't really bother, don't really need you guys to make money, because they work for B-book brokers that, prefer you to lose money, because that's how they make their money. But trust me, this is one of those concepts that'll open your eyes to how the market really works. And it's definitely something we're going to keep harping on about and keep mentioning in future modules, and it's going to be a great indication of what the market is trying to do. This was also an example that I've discussed many times before on seminars and on YouTube videos, and here guys can see the concept of liquidity quite clearly. After the market, it had these highs over here that it spiked, and this was when the media started calling for parity on the euro pound, and then it came crashing down. It printed a low here, went up, and then it came down. It actually just took those lows, had enough fuel, or gathered all those sell orders, because everyone that was long had sell stops over here. So when all those sell orders triggered, they sell to the market maker, they buy, price shoots up, comes down again, takes the liquidity again, shoots up, comes down, takes the liquidity again, shoots up. But as you guys can notice, there's some more liquidity down here, and eventually the price kept on coming down until it took these lows over here before it started moving up. But if you guys just look at the other side of the market printed all these highs, and it actually never ever took those highs like it did taking the lows here. So all those sell orders are still waiting at the top here. So like I say, if there's orders there, the market's going to go and grab them. So just marking them off, as you guys can see here, the red lines are untagged liquidity, or liquidity that was left in the market. And like I say, the market will be drawn to this like a magnet. And moving forward, as you guys can see, it actually cleared all that liquidity, and then came crashing down to this low, and then again to this final low over here before having quite a big reaction. So yes, these are definitely going to be areas that we're going to be watching, and just make a note and see how the market moves between these liquidity points.